Good day. I am Dr. Suresh Rama, Head of Rates and FX Strategy for RHB Group. Today, we like to highlight the dollar, which is caught between geopolitical risk and the US Fed tightening of monetary policy. On market positioning, we note speculators' net long bets on the dollar fell in the week ending 15 February according Commodity Futures Trading Commission data. The value of net long dollar positions was at $6.17 billion compared to $7.57 billion a week earlier. In the fixed income space, speculators' bearish bets on US 10-year futures for the week ending 15 February fell to their lowest level since late October to 174,063 contracts versus 201,910 contracts the week before. On the Fed's interest rate trajectory, we revised our 2022 US Federal Reserve Bank Fed fund rates forecast to 3 hikes of 25 basis points each. We don't rule out the possibility of 4 hikes in 2022, though this isn't our base case forecast. Much of these hikes will be front-loaded as year-on-year inflation prints remain elevated over the next few months, even though the month-on-month prints could remain stable and perhaps fall in second quarter 2022. In our previous assessment, we had stated that the Fed will hike the Fed fund rates by 50 basis points in 2022, with the balance of risk tilted towards 75 basis points in hikes this year. We maintain our view that the first Fed fund rate hike of 25 basis points will be announced at the March 17, 2022 FOMC meeting. On the geopolitical front, we note the Russian ruble is under selling pressure. Dollar ruble slipped past 80 as Russian President Vladimir Putin called for the immediate recognition of two breakaway regions in eastern Ukraine. In the equity market, the dollar-denominated Russian Trading System Index is also under selling pressure. Putin signed a decree recognizing the breakaway regions in eastern Ukraine as independent entities, upping the ante in a regional crisis the West fears could erupt into war. We are maintaining our short Aussie dollar trade that was recommended on 15 February on the back of risk aversion play given the tensions between Ukraine and Russia. Aussie dollar, which is sensitive to risk appetite in global FX market, is susceptible for a retrace. The trade has an entry point of 0.7125, target 0.7025, stops at 0.7250 for a 1.4% return. We are also maintaining our long dollar sync trade that was recommended on 17 February with an entry point at 1.3425, target 1.3550, stops at 1.3325 for a return of 0.93%. Bottom line, we believe the dollar will remain firm and steady in the near term as both factors, geopolitics and the interest rate trajectory by the US Fed, plays in favor of the dollar. The technical picture for the dollar continues to reflect the balance of risk of an upward trajectory for the currency. Key levels being eyed are 97.47 on the upper Bollinger Band. Once breached, it paves the way for testing 98.0 on the top side. Any retrace should see support at 95.50 and at 95.0. Thank you for listening to this podcast and wishing you the best on your investment decisions.